What if I told you the entire economic foundation just shifted beneath us in a matter of days? Listen, this is Max coming at you from UNFR with an exclusive macro breakdown for the Midas Touch network. Here's the thing, and I'll be completely transparent with you right now. I'm basically swallowing my pride today because when I glance down at my notes sitting here in front of me, I'm looking at some numbers that initially seemed almost too good to be true. Gasoline prices trending downward, equity markets rallying significantly higher, inflation metrics showing decline, and employment figures pointing upward. So based on that surface-level snapshot, it appears as though I might owe the current administration a slight acknowledgement, maybe even a small apology for my skepticism. Oops, wait, hold that thought for just a moment. Markets absolutely plummeting this morning as President Trump makes the declaration that there will be absolutely no negotiated settlement to end this military conflict with Iran without their complete and total unconditional surrender. That single statement is causing crude oil valuations to skyrocket dramatically. Wall Street simultaneously getting hammered by February's employment data that just dropped moments ago, revealing that the United States economy actually shed 92,000 jobs throughout last month, drastically missing what analyst forecasts had predicted. The unemployment rate simultaneously climbed upward to 4.4%. Yeah, so everything's basically combusting all at the same exact time because what we're witnessing is a fundamental transition from what I'd characterize as a subdued recession into what's unmistakably a wartime-driven recession. Essentially, we're talking about different variations of economic darkness here. And we're going to methodically work through every single aspect of this situation in today's comprehensive macro analysis. Further into this episode, we're going to conduct an extensive, deeper examination of the employment marketplace because the most recently released private sector numbers appeared like they were positioning themselves to demonstrate pretty solid robustness. But then suddenly we received an absolutely catastrophic jobs report that didn't merely fall short of consensus projections, it actually revealed a massive contraction in United States employment opportunities. Now, to properly help us establish the foundation necessary to understand this particular phenomenon we're witnessing, we'll be hearing directly from Kevin. Since I didn't receive the Federal Reserve appointment, I'm apparently just going to adopt a snarky and dismissive attitude from this point forward. Hassett had this to say. Well, we experienced the extreme weather conditions in February. The absolute worst portion of it actually occurred outside of the official survey collection week, but there remained a substantial amount of lingering complications, as you probably remember with the ice formations that were literally everywhere across regions. We also had some labor strikes happening on the western coastline that eliminated somewhere between 30,000 and 40,000 jobs from the count. And so my assessment is that on a net basis, it's virtually like a neutral number. I understand. So according to this interpretation, it was merely a handful of strikes on the West Coast combined with snowfall that simply made it a wash situation. It's definitely not attributable to mass deportation initiatives or supply chain disruptions and the resulting inflation stemming from tariff implementations. It's absolutely not because of the widespread loss of healthcare coverage accessibility or tax reduction policies benefiting the wealthy demographic. Unprecedented consumer debt levels reaching historic proportions, asset price inflation making homeownership unattainable to the point where the average age for a first-time home purchaser has climbed to 45 years old, newly implemented stringent work requirements attached to federal assistance programs, even if you're dealing with illness, disability, or serving as a primary caretaker for dependents. There's the complete elimination of disaster relief funding for states experiencing devastating consequences of climate change impacts. And we're operating in an economy where 10% of the total population now accounts for 50% of all consumer spending activity. No, according to them, it's just snow. We're going to conclude this episode with an in-depth look at what the absolute hell is actually happening in the labor marketplace. But before we dive into that analysis, let's examine several of the moving components within the economy that are rapidly transforming underneath our feet. Let's kick things off with something that we've been continuously monitoring throughout the past year, and that's the repurchase agreement market. So this particular mechanism functions as the emergency brake system that the Federal Reserve deploys whenever there are either interest rate pressures building up or liquidity challenges materializing in the financial marketplace ecosystem. And the specific reason I want to begin our analysis right here is because the macro-level data points that we're about to explore together represent what's visible above the waterline surface. And regardless of how aggressively this current administration attempts to spin the narrative, you possess your own eyes, your own ears, and your own wallets that ultimately tell the unvarnished truth about what's really happening. But it's what exists below that surface level that becomes considerably harder to interpret and parse through accurately. Now, in our previous Midas episode that I'll make sure to link in the description notes, we conducted an extensive deep dive exploration into the private credit marketplace ecosystem. And this particular space continues to display major structural cracks and fissures to the extent where it's evolved beyond isolated one-off incidents and concerns. There are genuinely serious fundamental issues developing in the underlying plumbing infrastructure of the financial system architecture. And one of the primary ways that we can obtain a reasonable sense of the stress level building up, even though it remains virtually impossible to pinpoint with precision due to the inherently shadowy nature of how these markets operate and behave, is by monitoring whether overnight settlement transactions are occurring and completing within the Federal Reserve's designated target interest rate range parameters. So translating that into plain everyday English, there exist financial intermediary institutions that provide capital liquidity in the overnight lending markets to ensure that transaction settlements between counterparties complete without friction points or interest rates suddenly exploding upward. It represents a multi-trillion-dollar marketplace where interest rates get set independently by the counterparties themselves and the intermediaries that are laying out the actual cash for a very modest fee, which does accumulate to become a substantially big business when you're talking about that volume. But when one participating party, either option A, doesn't necessarily have the required cash on hand available to settle these transactions out properly, which admittedly is relatively rare under normal circumstances, or option B senses that there's a bit too much systemic risk at play in the equation, which typically represents the case outside of genuine emergency situations at least, then the Federal Reserve steps into the arena to assume some portion of the transactions at a predetermined fixed rate positioned below what the open market is currently offering to participants. It serves as a backstop mechanism or an emergency brake system, as I mentioned previously, and it provides crucial stability in these overnight lending markets. So what you're observing here in this data are specific instances already materializing this year where the Fed has been compelled to step in and intervene. In years prior to this period, it wasn't particularly uncommon to witness the Fed stepping in and intervening at, let's say, quarter-end closing or year-end closing, because that's precisely when transaction volumes reach their absolute highest concentration levels. But we've been observing a developing trend in this second Trump administration term of the Federal Reserve stepping in repeatedly during non-quarter or non-year-end time periods to supply emergency liquidity to the system. So we observed it occurring approximately a week ago where they absorbed $30 billion in securities overnight, and then again this week when they took on $9 billion at the precise start of the military conflict in Iran. And I'm beginning here with this data point to clearly demonstrate that the economy below that visible surface is already functioning as a ticking time bomb waiting to detonate. And it's been growing progressively louder and more insistent over the many months since Trump made his announcement about his Liberation Day tariff initiatives. Coincidence happening here? I absolutely think not. I'm surfacing this particular information to show you that when you overlay frontline economic challenges like labor market weakness and inflationary pressures, it means that these systemic issues are now beginning to bleed out all over the place throughout the economy. We've existed in a high liquidity and comparatively low interest rate environment Relatively speaking, of course, for the better part of 15 years now. And the broader financial markets and the overall economy have therefore been capable of withstanding isolated shock events like tariff implementations, or the looming prospect of job-killing artificial intelligence adoption, supply chain-driven inflation, and similar challenges for quite an extended time period, even if it's been occurring at the direct expense of the everyday consumer and the middle and working class populations. And now we've thrown absolutely everything into a chaotic blender with the initiation of a military war in Iran. A war that was initiated for no apparent logical reason related to American national security interests and was virtually certain to rip apart the one single thing that had been holding the Trump economy together at the seams, which was low energy prices across the board. Even though that was actually a signal of recessionary economic trends developing, it was the one factor that was maintaining inflation measurements where they were sitting. And this has been a consistent recurring theme across the board in the data. Inflation hasn't gone anywhere or improved in any meaningful way, but Trump was able to effectively hide behind flattened statistical figures because energy costs were tanking downward and dragging the entire comprehensive inflation index calculation down with it. Now that entire dynamic has completely gone away and vanished, which brings us directly to the next critical data point we need to examine. Crude oil valuations have skyrocketed well beyond any analyst projections because absolutely no one had military war with Iran on their prediction bingo cards this year. In actual fact, we were existing in a situation characterized by oversupply conditions and diminishing demand, already leading us toward a scenario that traders call contango, when supply and demand expectation forecasts become misaligned from each other. Pretty much everyone understands at this point now that this dramatic shift is occurring because Iran has essentially choked off the supply flow of Middle Eastern and Asian oil by strategically closing the Strait of Hormuz passage. Now, that particular action explains Brent crude pricing dynamics. But what's genuinely interesting and noteworthy is that the supply disruption has also inflated West Texas intermediate prices, which typically fall approximately 5% below Brent pricing benchmarks. So as you're seeing here in this chart, WTI prices have caught up to Brent levels, and the two are now moving in tandem synchronization and moving higher with each passing day. So the key critical question for the real economy isn't the spike itself and its immediate impact. It's going to be the duration of how long this persists. Because a short-lived price move lasting like a couple of weeks mostly shows up as a noisy bump in the monthly energy statistical numbers and a quick, painful reminder hitting you at the gas pump. But it doesn't fundamentally change or alter the trajectory of core goods inflation measurements in any meaningful way. If, however, crude oil stays elevated at these higher levels for several consecutive months, higher energy costs begin to seep into freight transportation, petrochemicals manufacturing, plastics production, and the entire manufactured goods supply chain ecosystem. Drivers are going to see and feel the first effects of this almost immediately at street level, and you're probably witnessing retail gasoline prices respond typically within days, because gas stations don't wait around for a full macro narrative to form and develop before adjusting the price sign out front of their locations. The statistical agencies, by contrast and comparison, will record these changes in distinct stages over time. First appearing in headline inflation calculations through the energy component category, and only gradually if the shock persists over time in the broader goods categories throughout the index. That's precisely why central banks will treat this as a classic signal versus noise problem requiring careful analysis. A temporary oil shock that lifts headline inflation measurements but leaves core inflation relatively contained and stable represents an argument for patience at the Federal Reserve. A long-lasting conflict-driven premium that keeps crude elevated high into the summer months, which happens to be peak driving season, and starts to lift underlying goods prices, would seriously complicate the deflationary story narrative and make rate cut timing decisions a lot more contentious and difficult to navigate. Either way you look at it, it'll give the Fed board absolute fits trying to untangle the so-called signal from the noise, as they characteristically like to say in their communications. While we're on this topic and discussing inflation dynamics, let's stay with inflation measurement data because there was another report that came out this week called the Import Price Index figure. So this data is for January time period. So all bets are completely off on how this is going to look in the coming months ahead. Keep in mind, this represents the foundation of inflation pressure building. And the report clearly shows that overall import prices edged up 2% month over month in the comparison, but it was only held in check and prevented from going higher by a drop in fuel prices dragging it down. Again, this has been the fig leaf covering for the Trump economy narrative. But non-fuel imports surged 0.5% on a monthly basis and 1.2% annually, signaling persistent underlying pressures from manufactured to finished goods categories. So when you take this data in conjunction with the recent producer price index jump that we witnessed, and you factor in what's coming down the pipeline with increased fuel and energy prices hitting, it means that inflation is ready to pounce aggressively on an unsuspecting consumer population. And what's absolutely insane about the timing of this war initiation is that it guarantees inflation acceleration, and he launched it at the exact same time period that people in the country are supposed to start receiving their tax refund payments. And if you recall this detail, this was the centerpiece talking point that Scott Bessent and Kevin Hassett and Donald Trump were all saying repeatedly was going to somehow jumpstart the economy in 2025. This was literally their biggest talking point messaging for the last year of campaigning. Just wait until those tax refunds hit bank accounts. No tax on tips policy, even if we destroy the tourism industry in the process, resulting in fewer tips flowing to hospitality workers. No tax on overtime earnings, even if it really only applied to roughly a third of overtime situations in practice. And now we're experiencing less overtime anyway because we're working fewer total hours because we're existing in a recessionary economy. But don't worry at all. When you get those refund checks this year, you're going to be so incredibly rich and prosperous. Even if the refund amounts are projected to be lower on average than the ones that we received in 2024 under Joe Biden's administration. And now with inflation coming roaring back with a vengeance, even those diminished refunds are going to be wiped out and gone. You know, I'm almost starting to get the distinct sense that these guys aren't talking to each other within the administration and they might not actually know what's going on around them. Anyhow, one last thing before we transition to talking about jobs, because it's an indication of just how chaotic things have become. This is the US dollar currency valuation. In recent days, the dollar has been strengthening in value against other currencies. Remember that one of the things that Donald managed to accomplish previously was the devaluation of the dollar, which reduced the purchasing power of everyday Americans significantly. Well, now it's beginning to strengthen back up, which is a curious but ultimately positive sign for certain reasons. And here's why this matters. When a country pivots toward a war economy structure, markets redraw the entire map of what counts as safe haven assets. In this particular conflict situation, the first instinct has been absolutely textbook classical behavior. Money is sprinting into the dollar and into dollar-denominated assets, like Treasury securities, pushing the greenback to its strongest level in weeks, because global investors are actively looking for a deep liquid bunker to park capital. Along the yield curve, front-end yields have come down from their highs recently, but they still sit positioned in the mid-3% range, while the 10-year hangs a bit over 4%. High enough that you get paid reasonably to wait in dollar paper investments, but not so high that it screams panic throughout the system. And that's the bond market's way of communicating that we still believe in the dollar as the backbone of a wartime financial order, even as we quietly price in bigger deficits ahead and a more militarized fiscal future for the nation. But out in risk land, the picture is way more fractured and fragmented. See, equities are rolling over significantly as investors mark down growth expectations and brace for the possibility that the Fed delays rate cuts further out, and that if oil keeps headline inflation elevated at these levels, then, things are going to be pretty dicey and uncertain going forward. So it is actually a positive sign, even though we have become the scourge of the world community, that the global investor class at least still sees the dollar as a safe haven destination for capital. Now, that being said here, at the same time, simultaneously, Bitcoin rose a bit on the news of war breaking out, which is totally counterintuitive to what I just explained because it's entirely a risk asset classification. Well, here's proof of where the president's priorities truly lie and what he cares about. Donald took to Truth Social this week to accuse the big banks of sabotaging his crypto agenda initiatives and to demand that Congress pass the Clarity Act immediately, which is the flagship crypto market structure bill ASAP to keep the United States as the world's crypto capital destination. So you've got this split screen happening here simultaneously. You've got the classic flight to safety into dollars and treasuries on the one side of the equation, and on the other side, a speculative bet that in the world of sanctions and weaponized finance and war spending priorities, politically blessed crypto might be the high beta hedge against the very systems that investors are hiding in for protection. It's honestly one of the more cynical and disgusting things that one can imagine against the backdrop of an illegal and costly war that started with the bombing of an elementary girls' school in Manab, killing over 100 children in the attack. And I wish this came as a shock and a surprise to me, but the depravity of this administration knows no boundaries or limits whatsoever. Now, with that context established, let's finish with the headline story to explain what the hell is going on in the jobs market situation. So the month actually kicked off with what looked like positive news on the surface from private payroll figures released. At least ADP private payroll data is out showing a jump in February activity. Private employment was up 63,000 positions. That beat the street estimate of 48,000 for the best month for job gains since July of last year's reporting. Education and health services sectors, along with construction, led the growth categories. The biggest laggards holding back progress were professional and business services and manufacturing sectors specifically. But the devil is always in the details when you examine this closely. So there are two narratives that are hiding below the headline figures that are very uncomfortable to confront directly. The first is where the gains can be found when you dig deeper. As Becky just alluded to in that clip, we've covered this before in previous episodes. We continue to see gains concentrated in healthcare employment, which isn't a net GDP positive indicator because it's a reflection of our aging population demographic and the need for sick care services. It's okay to have this kind of activity if you're reinforcing gains in the entry-level market for college graduates, let's say, or the manufacturing sector and other productive activities that will produce gains where the spending flows back into the real economy circulation. But in this case specifically, you're seeing wealth flow from an aging population into the private healthcare sector almost exclusively without broader distribution. And as far as those construction gains are concerned, we've unpacked that pretty exclusively in a prior video as well in detail. And it shows that the gains are concentrated in the non-residential sector, with materials and expertise revealing that it's primarily related to data center construction activity. It's not for big infrastructure projects that provide a wide benefit to communities or even housing construction to help with our supply issue crisis. Now, the other narrative here is with respect to the size of businesses doing the hiring. What the private gains show is a kind of barbell effect, where you see growth concentrated in small and large businesses exclusively. Now, at the top end, you're seeing the effect of basically monopoly power and purchasing power dominance. Again, it's okay to have that kind of growth if there's even distribution throughout the spectrum, because it correlates with rising wages for workers. The top gainers are usually higher paying salary jobs at the big companies with resources. But the growth at the smaller end without similar gains in the middle means that job seekers are settling for lower wage jobs at smaller enterprises without benefits. And this is borne out clearly in the wage data that shows that we have the lowest growth in both job switchers and job stayers on record. So overall, this continues to be a sign of a sick labor market struggling. Something that the Fed is keenly aware of and why they're loath to pursue aggressive monetary policies that would cause undue harm to the labor market foundation. And that was the good news portion, which of course was followed up with the bad news hitting. The U.S. economy unexpectedly lost 92,000 jobs in February reporting. The unemployment rate inched higher upward to 4.4% officially. The job losses were so far off the consensus expectations that it shook both the administration and the markets simultaneously. Of course, as you heard directly from Kevin Hassett earlier, they're doing their level best to downplay it as an isolated month anomaly. But remember, this was on the heels of the historic revision to 2024 data that showed the full year was the lowest job growth on record in more than 2 decades of tracking. Rebuilding the labor market foundation is going to be a tall order and enormous challenge. And one last note to leave on to reinforce this broader picture we're seeing. You hear a lot about the unemployment rate figure and how it ticked up to 4.4%, which isn't great news, but it's not a complete disaster either on the surface. The problem with this number is that it excludes people who've dropped out of the workforce and are chronically unemployed long term. But it picks up those who are chronically underemployed in the count, like gig workers and contractors, and anyone who responds to a survey that they've worked an hour, a paid hour, in the 4 weeks leading up to the report being compiled. Now, the real key here is the population size and the trend line direction over time. So you can see clearly that the labor force and the inactive labor force are growing in tandem together simultaneously. Mass deportation has led to net outflows of the population, which means the sample set of those in the prime age demographic at the top is shrinking smaller. So in relative terms, the figure keeps increasing percentage-wise, which is why labor economists can say, oh, the market's healthy looking. But if you look right below it at the total labor participation rate, which is anyone above the age of 18 who's not enrolled in college or the military service, the figure is now declining in a real way measurably. So the takeaway here is that every month, there are fewer and fewer of us working, while wages are also stagnating simultaneously. So our purchasing power continues to decline progressively. That's why every metric surrounding the labor market makes the archaic way that we choose to track unemployment so misleading and inaccurate. And as if the red flashing warning lights in the cockpit weren't enough to wake up this administration to reality, they decided to start a war instead. A war that promises to deepen the economic pain of everyone in this country, unless you're a shareholder of a military contractor corporation profiting. From the quiet Trump recession to the full-blown Trump recession crisis, so much winning for everyone. For the Midas Touch Network audience, I'm Max from UNFR with this analysis. Resources for today's episodes are in the description below, and make sure to subscribe to the free weekly newsletter at unfr.com for updates. You can find me on Blue Sky Social and on YouTube at UNFR as well for more content. This has been the Macro Take exclusively for the Midas Touch Network community. Want to stay plugged in and connected? Become a subscriber to our Substack at MidasPlus.com today. You'll get daily recaps from Ron Filipkowski, ad-free episodes of our podcast shows, and more exclusive content only available at MidasPlus.com for members.